Welcome to this edition of Fuel for Thought. I'm Kristen Balasia, Vice President of Consulting Services at S&P Global Mobility. In light of what we've been experiencing across the global markets, today we'll be talking about automotive in the context of capital markets. I'm pleased to be joined today by my colleagues, Michael Robinet, Executive Director, Consulting Services, and Demian Flowers, Product Management, Financial Markets. Good morning, gentlemen.
Good morning, Kristen. It's a pleasure to join you on this podcast.
Hi, Kristen. Hi, Michael. Yeah, great to be here.
Thanks. So let's get right into it. The automotive business has always been one, let's say, not for the faint of heart, but now is being faced with new and I'll say unencumbered market entrants, and at the same time, investment requirements, the likes of which the industry has maybe never seen. So, Demian, why don't we start with you and talk about, this industry that we're in has unique challenges for sure, different dynamics and frankly, realities associated with the capital markets that a lot of other industries don't have. So, if we can talk a little bit about the disparity between auto manufacturers versus each other versus other industries in the eyes of the investment community and why those exist, I think that would be an interesting place to start with you, Demian.
Yeah, it's a good question. And I think that one of the interesting observations that you can make about autos is that it's a sector that contains, on one hand, some of the cheapest companies that you can find anywhere, and also some of the most expensive, right? And probably the poster child for expensive is Tesla, and the poster childs for cheap are, probably any legacy automaker. But probably the metric that you're going to use to see that, most obviously, the most basic sort of valuation metric is price earnings ratio, looking at 12-month forward earnings. And on that measure, Volkswagen, for instance, trades on 4-5 times, and Tesla is on over 50 times, right? In answering how we got ourselves into that situation, there's kind of two halves to it. The one half is, well, why are these legacy automakers so cheap? And then the other part is, well, why is Tesla and its peers so expensive? The cheap part is kind of not new news. Yeah, these are companies that have been cheap for decades. And the reasons for that, there are many of them, but the ones often cited are, one, automaking, it's a very capital intensive industry, right? So relative to the profit that you get out of it, you need to put in a tremendous amount of capital, and that's unattractive from an investment perspective. The other one is risk, right? And we've seen this many times throughout history, but most recently during COVID. Whenever there's a crisis, automakers become very, very inefficient from a cash perspective. They absorb huge amounts of cash through inventories, and also potentially through having to bail out their dealers and their supply chain, which in a nutshell means that automakers are at great risk of going bankrupt in these types of crisis situations. And then the final one is lack of growth, right? There isn't really any structural growth. It's not a tech sector. There's few people that would argue that what the world needs, certainly in its big cities, is a lot more cars. So that's the sort of the cheap side of it. And then, right, so why are the tech guys so expensive? The key reason there is that expensiveness is reflective of the growth hopes of that part of the sector, right? And bundled into there is this idea that a lot of those structural challenges that those automakers have always faced are kind of getting answered by new entrants that do that job in a different kind of way, right? So they're more vertically integrated. They don't really have so much of a supply chain to have to bail out in those crisis times. They are not tied to dealer networks that they have to bail out in those crisis times. And the capital intensity is lower because the sort of mechanical simplicity of the vehicles that they're making is greater, right? And finally, there's new revenue models. They're doing software, they're doing autonomy, which kind of, quite apart from the fact that they might take over from all of the old guard, means that there's a new set of hopes that give us greater hope that these could be growing companies that they've got space to grow into.
And that's a really interesting point because we see a lot of the OEMs, and you mentioned a few of those things, trying to frankly look more like the tech guys or other business models that are viewed more favorably by the financial markets, right? But then in doing so, it requires a pretty significant investment. And so they need that access to attractive capital. And so it's this vicious circle. That's really interesting to see and as it unfolds. But the OEMs really get a lot of the focus. And Michael, I know you spend a lot of time across the industry, but in the supplier community in specific or more specifically. And there is such a large and diverse supplier community out there underpinning what the OEMs are trying to do, what the industry is trying to do. And they range, right, from small, medium, large, public, private. And they have their own set of financial challenges and challenges in general that they're facing right now due to a lot of the macro conditions that they're facing, as well as this transition to EVs very significantly. You know, maybe talk a little bit about that and maybe even the differences depending on where they sit in the supply chain.
Thanks, Kristen. No, you're exactly right. The supply chain obviously is critical. There's a lot of estimates that they contribute anywhere between 65 to 70% of the value add of the vehicle. So obviously, one is not going to be building a vehicle without suppliers in tow. We've had over 100 years to more or less build the supply base. This what we will characterize as the ICE supply base with the aftermarket and all the innovation and then the speed of development. And then certainly, Demian mentioned the word risk, and that is one area that suppliers are used to, but the level of risk that we're find ourselves in right now with respect to the fact that volumes have not been strong for probably about 2.5 years now, which you can withstand a year, maybe a year and a half, but 2.5 years really stresses the balance sheet and really puts a lot of pressure on the income statement and the like. So suppliers are not quite as certainly not as healthy as what they would have expected at this point in the cycle. So there's that risk. The other risk is this whole shift from ICE to BEV, from the internal combustion to the battery electric structure, and it literally impacts the entire ecosystem from a value add perspective, from some systems not really being required any longer, some new systems coming in, new suppliers coming into the fray, more traditional suppliers being under significant pressure. So there are a lot of more or less balls in the air that suppliers aren't really used to juggling. To be completely honest, I think the other factor you mentioned on the macro side is the inflation. In my 30 plus years of watching this sector, I've never seen inflation that is impacting the supply base. And as many know, most suppliers, at least a good part of their revenue is fixed. It's fixed, or at least it's governed by a contract. So when there's unintended inflation or unexpected inflation in commodities or labor or logistics or utilities, whatever the case is, it is extremely difficult to go back to your customer and ask for price increases just to try and stay above water. So we're finding that suppliers are kind of caught in the middle, and as you mentioned earlier, it's all about abating risk, trying to control it, and especially as Demian also mentioned, the capital side of the equation is absolutely critical. Suppliers, depending on the size, their banks may or may not give them as much access to capital as they may require, and it really can change the competitive dynamic going forward. So it's a very interesting time in the supply base right now.
Absolutely. And we've seen them navigate challenging times, but there's so many things, as you mentioned, kind of, I'll say, hitting them at once, that it's going to be interesting how this continues and unfold and how the industry shakes out. And we talk about investment, and Demian, going back to you and thinking about the last couple of years, I think the only acronym, and granted, I live in an automotive world here, but the only acronym I heard more than BEV, battery electric vehicle, in 2021 was SPAC. I think you couldn't open the paper or wake up in the morning and not read about another one, and pretty sizable. But it hasn't always been that way. And frankly, we're not seeing that in 2022. So, how has the industry investing changed over the last few years, and where do you think we're headed next?
I mean, I think probably the key things that have happened that brought us here over the last years, and it's been a multi-year journey, is that there's been a tremendous amount of change and innovation in the automotive area and in related areas. And it's got everyone very, very excited, right? And rightly so. You've had new business models like Uber, not that new anymore, right? But IPOing along with other ride hailers. You've had Google kind of creating and spinning off Waymo, as well as the whole sort of electrification journey that we touched upon before. And all of these things have drawn investment in, right? It's been a very fruitful and easy fundraising environment for a lot of the companies that have been involved in that whole sort of mobility disruption space, or whatever you want to call it. But enthusiasm kind of always comes with ultimately a reckoning, or maybe not a reckoning, but a reality check, yeah, at some point in time. And I think that that's what's been playing out over the last 12 months. So if you go and look at all of these sort of, cohort of automotive new entrants, right? And I don't so much mean Tesla, but the sort of people like Neo and Lucid and Rivian, the valuations of those, and they're all listed companies now, have been decimated from peak, right? They're sort of all down between 70 and 95%, depending on which one you look at. And that is to do with the market just looking at these business models and saying, hey, it's very, very difficult to start up and grow from nothing. And looking at it with more scrutiny and pushing capital towards those ventures with more scrutiny. In a way, the SPAC boom was, the peak of exuberance, right? Because these are essentially a blank check method of fundraising, where the people that are putting in the capital don't even know what they're investing in. There's no better definition of exuberance than that. And you've seen so far this year, the SPAC transactions rate dropped way down. There was over 600 SPAC IPOs last year, and the number this year is closer to 70 so far, about halfway through the year. There has been a big one like Polestar in recent days, so it's not totally over, but I think we're now in this period of a lot more scrutiny, a lot more looking for established business models, looking for sort of tangible, unit sales and revenues. And, the Polestar thing reflects that. I mean, Polestar is a much more mature business than some of the other sort of startups that we've mentioned.
And I think that's going to be a welcome change to many of the established or existing players, right? I mean, I like that word exuberance, and looking at this year, um, it seems that a lot of, again, the traditional established players would be breathing maybe a sigh of relief, seeing that we're at less than 10% through the year so far is what we were the full last year, that maybe that'll kind of slow some of the some of the new market entrants, and that scrutiny may highlight that, the traditional consistent players established may not be such a bad investment going forward, and could offer some advantages. And
Yeah,
I
it's
think,
kind of a cleansing. Yeah, it's like you saw
yeah.
at the end of the dot-com boom and bust. I think that few people would sort of say that this is a bad thing, as hard as it may be for certain good companies in this environment, maybe being tarred with the wrong brush. But it's a healthy process that we need to go through.
Right, right. And we're seeing some of them already, like you said, start to go. They came quickly, a big flash, and now they're leaving almost as quickly. So let's go back to the supplier community, and maybe as we look at the OEMs, the new players, it's a full evolution of the market from end to end. So Michael, if we look at that and we look at what suppliers are likely going to have to do, they're going to have to partner possibly with each other, with the OEMs. They are evolving, they're having to evolve. And it's really, I think, a mandate for the broader industry to be successful that they do that. As we've learned through the recent supply chain crises, I don't think we'll get to the technology, the pricing, the supply security, and balance a world that still produces ICE and EV vehicles today. So what do you think that could look like? The evolution of the supply base to navigate the challenges, the opportunities, and frankly, just the significant change.
Well, it's an interesting perspective, because if you kind of look at the industry over a several decade perspective, or I would say, let's say even a couple of decades ago, any alliances between an OEM and a supplier were few and far between. You might get the occasional supplier that would run a stamping plant for a vehicle manufacturer, or some other maybe operation, maybe build vehicles on a contract basis. But it was very limited. But as we have seen, technology moves so much more quickly, and I think speed is at the core. Speed and actually access to technology are really at the core of why we're seeing so many joint ventures, affiliations between different types of suppliers, so that they have more of a system solution versus just a component solution, or between a vehicle manufacturer and a supplier, where we see virtually every new battery plant going up is not exclusively owned by a vehicle manufacturer. It's got a battery supplier in tow to bring the technology and some of the process capability to the to the manufacturing floor. So you're going to increasingly see the only way, and virtually every OEM is doing this. I mean, there was a time where, in my days, I would remember companies as big as General Motors and Toyota, doing a lot of their own innovation, and maybe occasionally using supplier innovation. But those days are well behind us. A lot of the innovations coming out of the supply base, or jointly with a vehicle manufacturer in some sort of affiliation. Then, of course, you've got OEMs that are working together, GM and Honda. You've got Volkswagen and Ford, obviously Toyota and all their affiliates, and the reason for that are multifold: economies of scale, speed to market, access to talent, innovation. And then also, I think what's really important is, in the future, given all these changes in the ecosystem, what are the true differentiators that Mr. and Mrs. Smith, who purchase a vehicle, what are those true differentiators as they drive that vehicle from one vehicle manufacturer to the other, especially in the BEV world, where software is so much more important, and controlling the experience. So what it all really boils down to is that no one company can do it all on their own. They have to have affiliations and joint ventures and agreements that are long lasting, share capital risk, share talent risk, share technology risk, and actually help speed to market. Because the old days of waiting 5 or 6 years to get something to market, those are well behind us. We have to move much more quickly because the industry is driving us in that direction.
Absolutely. Absolutely. And I think we've seen the industry being pretty resilient and creative. And, I have no doubt that that will happen in the future, but it'll take a lot of people rowing in the same direction, and doing things maybe a little bit differently. So along with all of this, Demian, maybe one final question for you. So we have these new market entrants, we have all these different dynamics at play with the financial communities and EV investment expense, um, companies looking to gain access to attractive capital. We're dealing with significant currency fluctuation, and in markets that that doesn't typically happen, and it's really kind of happening everywhere. How is that impacting the industry? How is that impacting OEMs differently? What should people be looking for and expecting?
Yeah, I mean, I think currencies move around all the time. The currency markets are very, very volatile, and we don't normally spend too much time worrying about it. We can sort of hedge exposures, and we just find a way to live with it, because these waves tend to ride their way out over time. But I think what's different now, and Michael was talking about it earlier, is the inflationary environment that we're in, and the fact that different central banks are responding to this global inflationary environment in quite a broad range of ways. And the US in particular is sort of dealing with it in a way that's sort of relatively aggressive in terms of its interest rate response relative to other central banks. And what that means, well, there's other factors involved as well, but the dollar has now wound up at a 19-year high versus other currencies. And I think that the prevalent feature of the currency markets now is dollar strength. And this year alone, the yen is 15% weaker, the pound is 11% weaker relative to the dollar than it was at year start. So what that means is, well, for automakers, right? So if you are generally doing something that is very cross-border, right? So if you're making cars somewhere other than where you're selling them, These are the guys with the most currency risk, which basically means premium, right? Volume cars are generally made where they're sold. Premium cars are often made in one place in the world and sent all around the world. If you're exporting vehicles out of the US in the current environment, that is bad, right? So I think that US automakers have seen, from a share price perspective, themselves getting hit pretty hard this year, parallel with this sort of currency movement that we've seen. Who's benefited? Well, it's the premium guys that are selling stuff into the US. So, German premium. So if you go and look at the German automakers who've all got sort of, relatively high exposure to premium, they're the beneficiaries. As I said, currency tends to sort of even itself out over time. But if this is sort of indicative of a sort of quite different cultural approach now by different central banks, then this could be something that ends up persisting and ends up actually playing a big role in how the industry sort of shapes out over the coming years. So we have to watch it.
Absolutely. So, Michael, final question for you. You have been, as you mentioned, I'll just say decades, I won't say how many years, you've been watching this industry, forecasting this industry. What are your final thoughts about the time that we're going through now, successes, risks, and what is your perspective right now?
I think no matter how we look at it, we're going to see turnover in the supply base. Some suppliers getting larger, others exiting, others doubling down in whatever sector that they're in. It's going to put more and more capital and talent at risk. And so certainly the supply base, and also one last aspect is the definition of the supply base. We're so used to this OEM tier 1, tier 2, tier 3 type of structure, but all of that is increasingly being blurred as we bring in software, as we redefine the value equation, with vehicle manufacturers building more of their own content going forward. So the lines are blurring, the risk is rising, and certainly the speed of the industry is paramount. So it's definitely a heady time in our automotive ecosystem.
Great, fantastic. Well, with that, we'll end it. Thank you, Michael. Thank you, Demian. Thank you for joining us today, and we'll be back with more Fuel for Thought next month. To opt into our newsletter that provides more information on this topic and others, please visit spglobal.com/mobility.